In this week's update, no follow-through from brief bursts of selling. The move in gold appears sustainable and wonderful opportunities in the US and in Australia. My name is Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Let's start with our normal market perspective. This won't be a long video this morning because nothing really has changed very much. There's still no negatives in the US charts. However, we need to be alert, particularly after more than 5 months of incredible rally. And I know 2024, I've been saying this since late last year, has set up as just about ideal environment for stocks. But we've got 5 months of rally. We're heading into the time of year that seasonally can tend to be a bit weaker. There's some valuation questions being asked of the major stocks in America. So just be on alert for a character shift in indices, because they're pretty obvious to see when you know what you're looking for and you're prepared to acknowledge that they're there. Now, I wouldn't be surprised if we get a retest of the breakout in the S&P, which is at 4,800. So that's 450 odd points below where we are at the moment. That would not be unreasonable. It's about 7 or 8% down. In fact, that would be pretty normal. In fact, it would be, I'll go one step further and say it'd be abnormal if at some stage in the next few months we don't get a correction in the US indices of somewhere between 5 and 10%. That would be the most solid chances, I think, in the US market. But having said all that, as far as calendar year 2024 goes, the end still looks higher and quite possibly significantly higher from here. I wouldn't rule out the possibility that the S&P could finish above 6,000 by the year end. So I remain extremely bullish about the overall, and I remain incredibly bullish about selected stocks that have been well researched. And I think we're going to see a number of tremendous outcomes by the time we get to the end of the year. Stock selection has never been more critical, though. We're seeing enormous divergences between the stocks that are performing well and the stocks that are getting beaten up. So stock selection, absolutely critical. If you don't do that well, you can do quite a lot of damage to your portfolio. And a clear game plan is never more critical. You need to be absolutely clear what the purpose is for each transaction, the time frames involved, if you are going to have stop losses, where you're going to put them, just all those simple, normal things that need to be done that most people, perhaps don't want to do. They just want to buy stocks. They want to take tips and cross their fingers and hope it all works out. But look, a simple, clear game plan and good stock selection, I'm convinced, can deliver very, very good results. So the US market, the S&P ended up down 1% for the week. I think it was only the fourth week of the year where it's been negative, and they've all been very small. And we closed well off the lows, as you'll see on the chart. Energy remains the sector leader. But selected small caps are still trending very powerfully. There's some terrific trends in that part of the US market. US dollar index eased a fraction, 104.3. The 10-year yield was pretty much the same, 4.4. But the VIX did kick up a bit, up to 16. So certainly some increased apprehension in the US market based around the inflation data and the jobs data on Friday night. All right, let's jump in and take a look. There's the S&P on a weekly chart, and you can see we closed well off the lows. Now, when we go into a daily chart, you can see there was a very, very sharp move on Thursday, and this is the essence of the market that we have right now. This on Thursday opened very strongly. You can see it gapped up considerably, traded higher for a little bit, and then gave it all back in very robust fashion. So that looks like an absolute classic big red reversal candle. But there was no follow through at all. And that's just so typical of the US market. And I think what's happening is a little bit of profit taking starts, and then the algorithms kick in and just drive the stock prices and the indexes down to their session lows. And most of that happened in the final hour. So whilst that looks like a very ugly candle, it all happened in the final 60 minutes, and then all was forgiven and we bounced back on Friday. So the end result was that, which is, looks pretty mild. Now, what I was talking about earlier is the possibility of a retest to the breakout. That happens more often than not, and that is around about the 4,800 level. We closed at 5,200, so it's about 400 points down, or about 7 or 8%, that's a pretty mild sort of retracement, really. Now, we may not see that in April, because seasonally April tends to be a pretty buoyant month anyway, tends to be an even better month in election years, and tends to be an even better month when it's an overall really strong bull market, as we have in 2024. So there's a lot of seasonal reasons why April may continue to push higher. But if that is the case, then I would be on a little bit more alert running into May, because at some point you'd have to think we're going to get at least a 5-6% pullback in the market. So that's the S&P. Let's look at some of the individual differences and spreads where the money is actually going in the US. Nasdaq versus the S&P continues to just ease back a bit. There's nothing dramatic here. So the Nasdaq is just underperforming the S&P just a little bit, but there's no change of character there yet. If we look at the Nasdaq, this is also on a weekly chart, very similar. Now, we're just stabilizing here. We haven't rolled over yet. And if we go into the daily chart, you can see it's very, very similar to the S&P. So we had a sharp move down to the 50-day moving average, found support there, and turned up again. So there's no change of character here yet. It's leveling out. Now, it wouldn't take much. We'd only need to, perhaps break these lows here, break this low, and that would break the sequence and effectively change the character of the trend. And if that happens, then just on a technical basis, that could trigger the algorithms to sell off further. So that's probably a key level, I would think, on the Nasdaq. Around 17,300 is a pretty important level, and that could confirm the change of character. At this stage, all we've got is just a bit of a tap on the shoulder. We don't know whether this is just going to consolidate high sideways and then just continue on, or whether we will get something more significant. So that's where we sit. The SMH, the semiconductor ETF, looks very similar to the other charts. So there's really no difference here. And SMH versus the S&P, again, there's no real change. It's just we've now got roughly equal performance between semiconductors. So it's not like they're being heavily sold off. And when you've got stocks like Nvidia that have gone up 300-400%, you would think that some profit taking would kick in and really push this ratio down, but it's not happening yet. Let's look at it on a sector basis. This is over the last quarter. Energy has come from right down here. The middle of January, energy was at the bottom of the queue and easily at the bottom of the queue, and now it's at the top of the queue and really performing very strongly. Next up comes communication services and then technology. So they've lost their leadership position, but not by much. So we don't have the heavy-duty selling in Microsoft and Meta and Google and Amazon that a lot of commentators have been predicting. So not a lot of change there. Hanging around the bottom, surprisingly, healthcare and consumer staples. So there's no real move to defensives yet in America. And consumer discretionary is being dragged down by the poor performance of Tesla. So Tesla does have an impact on XLY, so I don't pay a great deal of attention to that sector index because of the significant contribution from Tesla and from Amazon. One positive at the moment and one quite negative. Turning to Australia, over the last quarter, we've seen some pretty heavy selling in the information technology stocks in Australia. They were absolutely killing them up until, where are we, the end of March. So it's been the last 2 weeks. We've seen hefty selling to the downside. And what's happening there is that the moves in the Australian information tech stocks like WiseTech Global, Xero, those sort of stocks has very much amplified what's happened in the IT sector in the States. So I think these stocks they'll go through their profit-taking cycle and then they'll probably just bounce back and continue on with their trend. Next, we've got the finance sector. Small caps still holding up very well as an index, and individually there are still some very good trends continuing on in Australia. And the final one I want to look at, this is large cap growth versus large cap value. Still, there's nothing there in that chart that suggests, and it's these charts where you often see the change of character first. It's these ratios between growth and value, or growth or aggressive sectors and defensive sectors that you often see the initial, and this is what happened in 2021. This was the first thing that I saw that changed character, and there's nothing there yet. But keep an eye on it. It's important. There's the long term. That's a monthly chart going back to 1985. This is the equal weight S&P. We've broken out. Nothing much has changed there either. Small caps. This is the Russell. We've broken out there. Had a little pause last week, but again, nothing dramatic. And this is the mid cap 400 as well. So there's just nothing there. Nothing has changed. The market just feels a bit more nervous on an intraday basis, and probably is. The volatility is up, and we're seeing that with the VIX now poking up to 16. I think higher volatility is going to be the norm for the rest of 2024, and that's why I said at the start, it is just so critical that you are very clear about the purpose for every transaction, because it's when the volatility goes up and prices start moving around very quickly and further than what they have been, it's easy to get thrown offline. It's easy to make wacky decisions based on fear and greed and whatever other emotions are happening. So that's why clarity around your process and your purpose is so critical. All right, that's the US market. Let's just quickly look at currencies. This is DXY, the US dollar, down a little bit towards the end of the week, but not a lot of change, and the Australian market is just mirroring that, so there's really no significant differential. Moving now to Australia, 65.12 is where we finished. Our index was down 1.6 for the week, but the volumes were pretty muted on Friday. The moves weren't insignificant, but not a lot of selling volume behind it, and that's why I think our market is reacting a little bit more than it should be, and certainly it is amplifying what the US market is doing. Given what's been happening with commodities, expect the new week to start reasonably well for commodity stocks, pretty much across the board. Obviously, precious metals are going to do well, and we'll get to that in a minute. But copper, uranium, and even a few lithium stocks are looking a little bit better. So expect that to continue. There are a couple of possibilities. Picking silver stocks in Australia for many years has been hard work, really hard work, and they just seemingly positive projects never seem to get off the ground. But there are just a couple of possibilities that are emerging that I'm highlighting to members. All right, precious metals, gold had $98 for the week, another big week. 23.30 was the finish in US dollars. It's a combination of central bank buying, as I've been highlighting now for some time. We've got geopolitical issues, particularly in the Middle East, that are a concern. And there's also this continued move towards negative real rates. And you don't necessarily need to be at negative real rates. And if anyone out there doesn't understand what a negative real rate is, it's the nominal interest rate minus inflation. And when inflation is higher than the nominal rate, then you've got a negative real rate. And it's just moving from positive to towards negative. That is a good environment for gold stocks. So that's why we've seen this improvement in gold. It's been an explosive move, as you'll see. We had nearly 3-year consolidation, and this is one very powerful move, as I foreshadowed a few months ago, if we were able to break out, because it had been consolidating for so long. And it's like winding up a spring. You just create so much energy, so many participants waiting to see whether gold will break out or not. And then when it does, everybody jumps on board. Translates to Australian dollars, 35.48. So this is incredibly profitable territory, even for the high cost producers that are, in the 2,200 Australian dollars per ounce of all-in sustaining cost. That's still very profitable territory. When we look at the global scene, GDXJ was a solid finish to the week, but it's only just really keeping pace with the increase in the gold price. There's no real catch-up yet, and that catch-up will occur at some point, and when it does, the catch-up is going to be massive. So I think there is, now that gold has without any question is now confirmed the breakout and a powerful new trend. Sure, that gold stocks will be volatile, but at some point there will be a period of rapid catch-up, and I think things will look particularly good for gold stocks. There are many reasons put forward why gold stocks have not responded over the last year or two, but at some point I feel confident that they will. And locally, the place to be, in my view, is the emerging producers. It's not the existing producers. It's the emerging producers where you really get bang for your buck. All right, let's go and look at those charts. Actually, we'll look at the silver price first. So there's silver on a weekly chart. Now, silver had been consolidating since March of 2022. So 2 years of consolidation. And if you want to come back to here, then you could say getting on towards 4 years of consolidation. And this was a big move, finally. And at some point, silver will outperform gold. It's not really happening yet, but this was a pretty good start. This is gold on the weekly basis. So this was our consolidation going back to July of 2020. We had a quadruple top, another little pause, and then the breakout happened 4 or 5 weeks ago, and it's been very strong. We've moved from 2,075 to 23.29. So that's a big move in the gold price, and that's what it looks like on a daily basis. So we had a very, very strong opening to the week and a very strong close to the week in the gold price. Looking at GDXJ, you can see, yeah, we've broken out, but it's just keeping up barely. Now, GDXJ does capture a lot of the world's biggest miners, gold miners, and they've been underperformers for a number of years. So I guess that's probably what's holding something like GDXJ back. But as I said, if you want to be very selective, and certainly in my memberships, I'm covering off my preferred gold list, which I think are the stocks that are going to give us the better outcomes in Australia, then they're certainly doing a heck of a lot better than what this chart looks like at the moment. All right, that's the precious metals scene. Other commodities, copper up nicely to 424, nickel 783. Crude oil was a big story, higher to almost 87. We've got tight supply, we've got pretty solid demand, and then we've got Middle East tensions, which equates to very high geopolitical risk. So this is a perfect storm for crude oil. Who knows where it goes from here? If anything, if there's any flare up of war in the Middle East, then you'll probably see crude break through $100 pretty quickly. Hard to see resolution. The problems in the Middle East are just seemingly so intractable that it's hard to see the geopolitical risk settling down. So I think we're going to have buoyant oil prices for some time, and that's not going to help inflation, and that's also not going to help the Fed rate cuts, which is partially how the US market is being priced. So that's why running into May, I'm just even more on alert. Even though I'm net incredibly bullish for the remainder of 2024, there's a lot of things that could disturb that stability. And the Middle East and oil is certainly one of those. There's the spot copper chart. So a good week for copper, and there's the crude oil chart. So it's been quite a strong move this year. We were trading at 70 at the start of the year, and now we're basically at 87. So it's been a strong move in crude oil. Wrapping it up, I'm just going to repeat what I said last week, because I just couldn't think of any better way to finish the video than the way that I finished it last week. I think the message is very important, so I'm going to repeat it again. Don't be put off by these new highs. If you've got a great stock that's also trending well, then don't be put off by the fact that it's just set a new 52-week high or whatever it is, and that it's maybe been trending for a year or 18 months, because in this sort of environment, these stocks can just keep going and going for very long periods of time. So don't be put off by that. I'm not saying don't ignore it. Have all your normal sort of processes in place for taking profit, but don't be put off by it. There is very significant profit to be made in 2024, irrespective of what happens in terms of periodic market corrections. But it's not going to happen just by turning up, just by buying a bunch of stocks and just sitting back and folding your arms. It's not going to happen at all that way. You've got to be very clear about your process. You've got to work your process very actively. Have a strong target list. I like to have at least double or triple the number of stocks that I can buy, so that I'm not encouraged to buy some stock that I've got my heart set on. That's very dangerous, to get your heart set on a particular stock. Just have a whole bunch of stocks, and the idea of successful investing is not to own certain particular stocks. The idea is to make money in whatever stock you can with the least amount of risk. And I'd really encourage everyone to try and make that mental shift. Stop wanting to own a certain stock. What you want to own is a stock that's going to make you a very good profit for the lowest amount of risk that you can. And once you start to adopt that mindset, then your results are probably going to improve quite dramatically. It's easy when things are rolling along, when the market's been going up for 5 months, but to stay on a roll, you don't want to get greedy. You don't want to think that this is just going to continue. You've got to manage your risk objectively. Don't expect to just stay in something and it's just going to continue to go up and up and up. There'll be a few that will, but we'll see corrections in most of the market. Portfolio analyst last week, we looked at capitalising on the breakout in the gold price, of course, and went through my preferred gold stock watch list. There was also, we reviewed multiple stocks that were covered in March and ones in particular that are still buys. So they're still at a level, both fundamentally and technically, that are attractive. So that was Portfolio Analyst last week. More information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.